All right. Thank you again. I appreciate everyone here. My name is Herbert Diego. I am with FEG. I've been with FEG for about 8 years. FEG is Freedom Equity Group for those of you that have not been here before. This is a recurring session on Thursdays, and we appreciate your attention, your time, your precious time to take this 1 hour away from your busy schedule to study and share with us here. So, as you guys saw tonight, we are going to be talking about smart planning. We have a lot of subtopics, but we want to introduce new ways of looking at life and making income. We have always different pathways to make life, to forge forward. And tonight I'm honored. I'm very, very humbled to be presenting with my colleagues here that are usually on Thursdays. So it is an honor, it is a pleasure, it is a blessing to have such a wonderful session and be able to kind of share what we've learned and show others what is going out there and hear from you, get your feel, get your insights and your perspective as to what we always share here on Thursdays. So, without further ado, I'll go ahead and get introduced up here and share my screen. Okay, good. So, let's go ahead and get started on with this clean slate here. We may not have to use it. As most of you know, we are in this part of the world that is deemed to be uh, North America, the developed part of the world. And be it wherever you would be, we have a time frame, a time span of professional service. Let me introduce you to this 45-year plan that I've always like to talk to my colleagues about. I get this from Robert Kiyosaki. Robert Kiyosaki, for those of you that haven't heard about him, he's the author of Rich Dad, Poor Dad. And he has actually several great books that would really trigger one's mind to change their perspective and leap up in their seat as to how we should go about life, especially when it comes to career growth and development and trying to pursue life from a financial standpoint. Uh, this book that is inferred here is called The Cash Flow Quadrant. And as a matter of fact, it was written after the Rich Dad Poor Dad famous book that's been heard for by most of you, as I'm sure you guys have always heard about it. So later on, he focused on what Rich Dad did. I don't want to go get pivoted into what Rich Dad Poor Dad is all about, but the Rich Dad side, he later wrote a book that now focuses out of those two dads, he focuses now on the rich dad guy. What did he do in life to be rich? The story of poor dad will be for another time. Now, in this rich dad part, he says in this book that explores the rich dad part that he termed the cash flow quadrant. He has four quadrants that he believes that everyone out there has to find themselves in either of those four quadrants, or could be even more than one quadrant. But on the screen right there, you see the left side of the quadrant. And the 45-year plan is actually the actual amount of time everyone has to do meaningful work. We retire, it could be more, but on average, it will be 45 if you were to go through life in a proper way. Retirement is at 65, and serious work starts around 2018, right there. Young adulthood to retirement. If you take 65 minus 20, the year you start, begin really doing meaningful work out there on the marketplace, you would actually find you have somewhere around 40 to 50 years to, do some serious stuff, be it impact or business or whatever. Now, how do we go about this plan? If you were to, pause for a minute and think about the way you want to do this, take your 45-year plan or 50-year plan, whatever amount of time you have to work to actually do meaningful stuff out there, This is what he said in these four quadrants. Now let's look at the left side. On the left side, he said you have employees and you have self-employed. The employees, you guys know, these are the W-2 folks. The self-employed are the commonly 1099. And if you look at this in a most common way, the self-employed will seem to be, doing a little better than than the employed, than the employees, because they're self-employed, right? But Robert says both of these guys, they literally the same. They have no leverage. What does that mean? No leverage means they have one mathematical formula for getting money. They have to trade in their time to get money. And you can't get both. That's literally what he says. You have to give one to get the other. You can't have both time and money. You have to pay to be able to get your own time to do something else. Or if you want to, get that, money, you have to literally give in your time. So in this sense, he says this is the wrong side. It's a wrong side to be. If you're going to really spend your 45-year plan pursuing this, because he says he defines riches or wealth as actually being able to get both, getting time and getting money. If you can't have both, then you're not rich. In the developed world, they have money, but they don't have time. In the developing world, they have time and they don't have money. But also he says in this 45-year plan, he explains this factor of this curve here that you can see. As we age, our income grows over time and then it gets stagnant. Sorry, let's go back a little bit here. As we age, this is the age, the x-axis. I don't know which one at this point. I think I've been in school. It's been quite long since I've been in school. X-axis should be somewhere there, and y-axis. On the vertical side, it is the income, the amount of money. Now, it doesn't have to be exact those numbers that you're looking at. It could be, 50, 1,000, 1 million, whatever. But in the early age, we all tend to, increase our income. And around mid-40s, 50s, you get to, flat out. And in, 70s, early 60s, mid-60s, you retire. Now, this flow is the actual income, money coming in. Now, the funny piece or the craziest piece is that as you age, income does not only flat out, it goes all the way down and you have to rely on retirement. And this is a formula only lived by the people who are on the left side. On this quadrant, either you're employee or self-employed, but this is how you have to go about it. Over time, your body, your energy will fade out, and then you have to retire, and your income cuts in half, or even goes all the way down. Who knows where we're headed now? 95% of the people leave this side of the curve, of the quadrant, or live life through this type of growing curve. And it's very unfortunate because this is the time actually where you need money. Now look, at the time you actually need it the most, when your body now has become susceptible to disease and you need more help on things you used to do yourself, that's when money goes down. And this is actually a dilemma. But he says there's actually another 5% of the people that live on the right side. And what's happening on the right side? Let's look there. This is where we have 5% of the people. They have businesses or they are investing. Now, look at the formulas there. Look at the formulas here. Businesses can leverage systems to get dollars. So if you're leveraging systems to get money, so you actually have both money and time. Now, time is not in the formula here because where you had time, where you had to put in time, you've redeemed time and staged systems. That's what he means by leveraging systems. The leveraging of investments is actually another way to live on the right side of the formula. Now you invest, you use dollars to get more dollars. You use money to get more money. And in this sense, the curve will not only flat down, will not actually flat down, it will just keep going up and up even when you're out of life. Because remember, now the curve, the income growth is unlimited. That's why you see folks like the Walmart family or McDonald or whatever these big businesses that are based on systems and franchises that are based on, because they have the system. And at this point, the system is no longer a challenge or holding them back to stage their time. Now, this is what we're introducing this evening. We're introducing an opportunity to be on the right side. And what do you actually do on the right side? How are you putting up with the business, or how are you going to set up with the investment part? We're actually giving this both an opportunity of getting a shot on both of these at the same time. A chance to own your business and a chance to invest. And when we say investment, it doesn't necessarily mean investing on the stock market as we used to investment. Investing on the stock, yes, is one part. Investing in some other physical assets is another part. But the greatest part of it is actually investing in people, investing in developing other people, helping better lives. And with FEG that we were talking about earlier, we work around protecting people's lives. A chance to protect your life, protecting people's lives, and actually impacting them for the better. Now, speaking of protecting the standards of living, let me call it on a very basic, but life protection or the level of living that we would want to be is what we actually do in a very practical way. And this is what we're going to be showing you. If you can think of yourself or your family or your friends or your loved ones, where would you place them or yourself in terms of the standard living on this diagram? Now, on the screen here, you can see about 5 levels. And these actually go in a hierarchical order, from charity to bare necessity to getting by, comfort, luxury. If you can think of this as the Maslow's hierarchy of needs, but in terms of how we live, this ball here will represent, let's term it the standard of living that you're living tonight or today, as of now. You are meant to move. Everyone would want to move this ball upward from the charity piece, where you have to rely on food stamps and other things, to bare necessity, where you can at least afford yourself and maybe one other person, or getting by, where at least you can, you're able to pay all you need, at least, and maybe not save much. This is where the ball is right now. Right now, we're looking at it in the getting by quadrant. But the gentleman here that is we are looking at is trying to force it forward, upward. We're all working. We're all going to, trying to make ends meet, investing, doing here and there, at jobs, different 2, 3 jobs. But the whole idea is to move our standards of living upward. That's a common path that we're all in. And from finance or the business or entrepreneurship piece, we can for sure agree that only 2 things do get to move this ball upward: the idea of assets and the factor of income. So as you get more income, you get more assets. Both income and assets do move you upward from the lowest of the lowest to the highest level of luxury, living the kind of life you want and, helping other people you can afford to help on. So what keeps your family's standards of living, or what keeps your standard of living from lowering downward? These are the 2 things. Now, how do you get these 2? Maybe for income, you have to go to work, you get that job, but you're on the left side of the quadrant, if you remember. If something was to happen on that job, if your energy was to kind of, cut down, then the income piece gets broken. But let's, at least for a minute, think through this. If you are working today, if you have a job today or a business today, great. You're getting some type of income, but how do you sustain that income to keep going up as opposed to losing it or even having it flat out? How do you move on from even just income to adding more assets that helps you to keep moving forward? That's what we're talking about tonight. And we have risks. Don't look at these down, these below bottom pillars that are pushing this ball upward and think that's all there is. Because we have also other crazy factors that push us down. It's a tug of war of, some forces that you need to push you upward, and there are other natural forces that are always there to push you down. And the bad news is that most of these are variable. These two factors are very variable. They can vary. You can have, an income, certain amount of income and increase it, but the push factors that push you down on this ball are non-negotiable. Most of these are, very natural in nature. They are very inevitable. If you look at these four that will push you down, these are the factors outside of your control that can put down pressure, downward pressure on your standard of living or on your income, if I may say, or asset. Now, think of a time when your retirement, rather when your income has been cut in piece or goes away. If you lose your job, or if you retire, or if you're disabled, or if the death, or inflation, or taxes, look at all these five things. You literally have no influence on these. You have to retire. Disability has, it comes in, at a time you least expect it. Death is a factor. It's a matter of when, not if. Inflation, we can see what's happening now. Taxes, I have to, I don't need to say more about these ones. But these are all forces that we have to face that cripples our income and over time our assets as well. The gentleman here was trying to push himself forward to the comfort level, but look at what comes up. Trying to, all these factors, even one of these alone is enough to push you down if your income and assets are not strong enough. And what would happen in that case? If you were no longer around or able to earn any form of income. Look at the income pillar. It's broken now. So a permanent life insurance policy can provide a wage that will help your family, that will help yourself to stay in that place where you are, or even keep going upward in the face of all those challenges of retirement, disability, of death, of taxes, of whatever. How do we maintain that income then? That's where we mention of life insurance providing a backup to yourself, to your family, to your loved ones, to your friends, to your community. For those of you that are impactful in your communities, we are mandated to educate our colleagues, our community members, to sustain themselves in the face of all those adversities that we just looked at about five of them actually, if I can mention retirement, because they all will retire, or death, or taxes. So when it comes to life insurance in itself, people have had, some, biases here and there, depending on what they hear out. And it's a very unfortunate situation where you have to come across these, people that would not even be able to dissect it deeper and show you how to go about it. In the end, get a negative vibe around it. But there are two kinds of insurance in the purest basic forms. There's a permanent type of life insurance, and there's a temporary part of life insurance. And this is what we're looking at right here. For a term, we would basically relate it to renting, if you can think of renting and owning a home. If you were to pass by an apartment or a property and they say this is for rent, you see this sign here? You know, for every penny that you're going to rent that unit, that penny is gone. But at least you have a roof on the top. And if you were to look at this for sale, at least you know, yes, you'll be paying in some cases even more money, but at least you know for sure you'll be owning and developing and growing some equity in that property. And that's how you relate the idea of life insurance about. It's either or. It's either term or a permanent policy. Now, when it comes to term, there are certain types of term. They could be, you know, annual, you know, yearly renewable term or level. When it comes to permanent, there are other forms, you know, sub-forms of permanent, depending on how it's structured. On the way you design it and structure it, you get some other subtypes of permanent, but it's still all permanent. It goes for, you know, your lifetime or the person insured's lifetime. And that's how we relate it to similar to owning a home. So what type is right for you? If you're looking at someone, or I mean, remember, this could be yourself trying to look at how you get into this, or how do you help someone get into this? How do you know which one is the right type for your community, your customer, your loved one, your friend? Here are things we look at if you're trying to determine which one is, you know, relevant in that case. So renting or term insurance would give you a place to live, yes. It's a temporary solution, as we mentioned. Usually it goes about 30, at most 30 years. Some companies go low to 20 years, but on average, it will be 30 years. You may find one or two companies that could go just over 30, maybe 35 at most. But commonly, you would think of how much time you want to cover yourself, to protect yourself, with the full knowledge that at some point it's going to expire. And that's the idea of temporary solution. It will just be a solution for that specific time frame. And after that time, if you're still around, then you're exposed again. And then we have the idea of being economical to start, but ultimately end up being more expensive in the long run when that time expires. Again, with term, you're not building any cash. There's no investment part in it. The premium cost is, yes, you know, there's a premium cost which is low for sure, but then it can go down the hill at some point. And then once the time expires, then you have to, you know, pay 3, 4, 5, 10 times more than what you were paying in the next term if you're going to keep going with that approach. On the other side, we have the owning piece, which is the permanent or cash value life insurance, the policy that now gives you some cash value, as we like to say. You see me here referring to CVLI, which is the cash value life insurance or the permanent policy. Yes, it still gives you a place to live. You get a permanent solution as well. It may cost relatively more than term, but can end up being better by the idea that you'll be having some value of cash that is being generated. Then there's a portion of the premium that is creating an asset. Remember, we're talking about the income and asset. If you're doing this for a business and helping other people, definitely you're getting income. But owning it yourself as well, you have an asset in there that you're building from the income, the premium that you're paying. Now, let's look at what exactly is in the permanent piece, and then we'll look at what is in the, out of these 8, which are those ones that are in the temporary piece and the temporary solution. Now, there are certain riders. These are things added into your policy. You can have more or less of these, but the riders allows you to pay additional money into your policy to increase your death benefit and cash value. And the more you fund your policy, the more you put in more money in your policy, the faster your cash will grow. the cash that you're actually keeping in the policy. Think of it more or less like having a savings account into your life insurance policy. And such riders premiums are used to purchase additional paid up life insurance options that can give you more loan, more access to cash. In some cases, actually very rare cases, you'd get some companies like mutual companies that provide dividends. These are profits. Remember, mutual companies are companies that are owned by the policyholders. In those cases, you would even add dividends. So the 8 benefits you would get in a permanent option, in a permanent policy, you have a death benefit, you have a guaranteed premium that does not increase or change around. You have a guaranteed cash value growth. You know for sure the amount of money that you're keeping in there is going to grow over time as it gets interest. It earns compounded interest. You have an additional growth through dividends that I was talking about. Once, usually in most cases, the mutual companies will provide dividends on the second anniversary. Then you have tax deferred cash growth, cash value growth. Basically that means your cash will grow on a tax deferred option where you would be taxed only when you get that money out. Then you're protected from creditors. That's another critical piece there, because your death benefit or whatever money that you take out, you access it first, or your beneficiaries access it first, as opposed to being touched by your creditors through collection and garnishments. Then the tax-free access to cash value that I mentioned about, and then the income tax-free death benefit, because at some point your protection, whatever protection that you're guaranteed on the policy, in due time when the incident is triggered of disability or death, then you get that benefit amount in terms of death benefit, as it's called in life insurance, tax-free. Now, with that, you're more or less like banking on the living benefits. If you're going to think of the challenges that we're talking about, remember the 5 challenges we talked about: the taxes, the inflation, the retirement, the death, the disability. You can use a loan option in your permanent policy as a flexible source of fund. That kind of cash that you're keeping in there over time grows and you're able to take loans out of. I mean, you can cash it out for sure, it's your money, but we mentioned loans here not to slow down the growth of your policy. And in these cases, you may think of an emergency if it comes up at some point, because you can't predict it. Or for those that are funding their education, or if you want to buy a property, maybe a car or a house, or you want to go on a vacation. Instead, as opposed to taking a bank loan, you take a policy loan. And these are the benefits that are into policy loan as opposed to a bank loan. Because remember, a bank loan requires approval. You can be approved for a certain amount, not necessarily what you applied for or what you needed for. What you may need maybe 100,000 for an emergency, and the bank approves you for just $5,000 or 35. But with a policy loan, there's no approval process, because the amount you have in your policy, and you're able to access that amount on a prescribed rate ahead of time. They say maybe on year 5, you can take out this much. Year 10, you can take out this much. On average, year 10 to year 15, you can literally access all your cash that has accrued or accumulated over that time. With the bank, there's a possibility of being denied. And with your policy, you cannot be denied. You cannot be turned down. You cannot be turned down. Maybe you may not have enough for you to address your need, but at least you know for sure this is the amount you have in there, and you're able to get it all out. Then we have the loan amount limited by the bank determination. In the policy, the loan amount is limited by the amount of cash that you have in there. When it comes to interest rates, banks give out loans based on your credit rating. If your credit rating is low, then you're charged high interest. With policy loans, the interest is very competitive regardless of your credit rating, usually low compared to banks. There's no fixed payment plan. You can pay. If you don't pay, then no collection and recovery stuff. you just get out of your death benefit, whatever you have to, whenever you have to cash out. So in a nutshell, there's no credit risks of you be having a bad or great credit or credit report or background runs or whatever. You can reduce the policy cash. Yes, for sure, you will reduce your policy cash and death benefit by whatever amount you take out. But at least you know for sure you're keeping track and are able to see how much of your policy is going down. Now, allow me to rest here really quick a little bit because I can see time is not on my side. I want to talk on something really important here. You may use these policy loans or whatever amount of your cash value in a real world or in a perfect world. In a perfect world, you would think mortgages will be paid off. You don't need that money. Or your kids will be grown at some point and living on their own, making their own money. So you're not concerned as much. These are very popular beliefs that people will not need life insurance later. Yeah, in a perfect world, you can think of that. But there's no such a thing as perfection, right? The real world, people move on average of 11 times in their lifetime, moving just from one place to the other. As I can tell, most of you here have all moved. We've all moved at least maybe, 2-3 times, if I can tell. People have kids later in life. We've seen that. Or grown kids even come back home when life, gets hard out there. They have to go back to, their mom and dad's house or mom and dad's home. 55% of workers plan to work after they retire. These are all things that will compel one to go back to work in ages 60, 70, 80, when you can barely afford to stand. We've seen people that go to Walmart in their advanced age just because the world didn't turn out to be perfect as they thought, but it's the reality. So why not hope on the best? Why not hope for the best outcome, but then prepare for the worst in case things go south? And that's where a cash value life insurance policy or a permanent solution comes into play here. And in that case, that it can provide you with a lifetime of protection and the value in the event of your life going downhill. Now, this is the piece that I wanted to talk to you guys about as I wrap it up. Renting versus owning and the cost of it. Because people have had some, confusion around, yes, which one is better, which one is that. But again, the premium, the idea of making the payments, those payments can be, a critical factor when you're determining how much you need to pay or the sustainability of whatever decision you're going to take. Now, I want you to focus and look clearly on this curve here that we have in front of us. As you can see here, age on this horizontal line and life expectancy, which is this line here in dots, they dictate the premiums that we pay in insurance. As a matter of fact, they dictate the initial premium, but also as you age, you would agree, as you age, your mortality, your risk of dying becomes increasingly high, because we can look at this mortality curve. In the young, early stages of life of age, which is around here, because aging is going this way, in my 20s, 30s, it's fine. The risk is not high, but it's still growing up a little bit on a very, upward slope, not crazy steep. But once you hit your life expectancy in America, I think anyone knows the life expectancy in America, in North America here, 83. That's where we are. I think Rwanda is somewhere around 79 or 72, I guess. But life expectancy, once you hit your life expectancy, look at how the risk goes incredibly high. So this is where we talk about, this is the factor that you have to factor in before we even look at premiums. Remember, we've been talking about the temporary versus permanent solution. Now, I want to show you the pricing, how you would look at the pricing, the costs it would take you to have one over time. Remember this mortality curve. For those of you that are all less than 50 right now, below 50s, yes, you're growing, but it's not as crazy as it seems to be once you cross this life expectancy line. But once you hit your 50s here, around 60s, 70s, it's already growing high than it started out. So that's a basic principle that we all agree about. As a matter of fact, if we can't agree on the problem, there's not even a single point in talking about the solution. And this is the problem right there. Life expectancy is set and fixed. Some people make it there, some others not. But the expiration, our growth and expiration of life grows over time and gets even way incredibly higher when we get in the advanced age, around here. Now, remember we said age and, of course, there are other factors of, gender, education, income, whatever, health conditions, but predominantly aging and mortality are the main determinants of the pricing in either permanent or temporary solution when it comes to life protection and maintaining a standard of living and planning for it. Now, let's start with a temporary solution. Let's see how price plays into this. Look at this next line here. These are two lines of temporary solution. Remember, I told you for temporary solution, we have a level term and an annual renewable term. You can say, hey, I need a temporary solution that I can always renew every year as I go. This is how its pricing will go. For the first year, it will be somewhere there. The second year, it goes a little bit up. The third year, it goes a little bit up. The fourth year, the fifth year. By the time you hit 10, 20, 30 years, that's how the price will be crazy. It goes incredibly high and faster. This green line here, that's a temporary solution that goes every year, every year, every year. But if you say, no, I need a temporary solution that goes for a certain temporal time, maybe 30 years or 20 years or 15 years, whatever amount of time you take, the pricing will be level, will be flat, unchanging for that specific time alone. And that is denoted here by this straight line down. If you take a 10-year term or a 20-year term or a 30-year term, you'll be flat for those years. And after that year, it goes crazy high, but not as high as annual renewable. Remember? And all of these prices, remember, they're all above our mortality rates. That may be a little bit, hard to understand, but I want you for tonight to understand how the price goes on these curves. We are just looking at the temporary solution right now. The orange color and the green color, both of these lines are temporary solutions in as far as how the cost will go. For a level term, the cost will be level, will be fixed, will be not changing for a certain time, and then goes crazy high in the second time. You may take another 15 years or another 10 years. It will still flat out, but on a higher level. Because remember, now you'll be aged. And if you keep going through that approach, then the price keeps going up and up and up and up. But look at the term, the permanent now. This is the permanent path. The flat line represents the unchanging nature of the cost of a permanent solution. If you see this straight down, once you take a permanent solution, whatever price you fix right there and then keeps flat. It doesn't increase over time. And this is the beauty part of it. Because who wants to keep juggling these increasing and, in the face of inflation and taxes and, unstable incomes. So at least we need to have it ahead of time and say, hey, I know for sure this is the amount that I can afford to pay, and you set it in stone going forward. We also have options of, customizing it to your income, so that way you're done with payments ahead of time. Those are things we're well able to do within the permanent policy. But even with the customization, the money doesn't change as you go. You are told ahead of time how much you're going to pay, or the cost of your solution, and that cost is set in stone for whatever time that you have to pay it. By the way, with whole life, it goes on age up to age 100 and more. Some basic whole life goes, stop at 100. Those are the lowest ones. We have other natures of, permanent solutions like IULs and stuff that goes over 100 up to somewhere around 120 years. So let's really keep this thing in mind. And you can think of this doing it for yourself and for other people. By doing it for other people, you're not just, impacting lives, but you're activating streams of income that are incredible, that you wouldn't even think of. That comes, as I'm going to show you in a minute here. But to wrap it up, renting your insurance, you get about 3 of the 8 benefits. Yes, you get a death benefit, which is guaranteed in your term. You get an income tax-free death benefit of, at some point. Then you get, you're protected for sure from creditors, given, depending on how that one is being structured. Your agent has to help you, set it up in a way that is actually guaranteed to protect you against investors, or rather creditors. And all the 8 benefits that we talked about earlier comes with a whole life or permanent solution, or IUL, whatever way you would call it, but a solution that covers your entire life. And in the end, upon the end of your life, your spouse, your kids, whoever, your loved ones will ask these kind of questions. These are the questions that will eventually come up. How much money do we have now? How long will that money last us? Are we going to be able to stay in this habitation that we are in? Are we going to have to move to another county, a school district, another country, or altogether? Going back upward, or if life is better going forward? So what do you want these answers to be? It's up to you, but your agent can help you prepare to keep your family's standards of living at the level you desire and forward. And remember this thing that we had here? Protecting those you care about by obtaining a life insurance policy means, fixing your budget. It's the right amount of cash that you want to pay that will determine how much of a policy you get. And such types of insurance coverages fits your needs if you have the right person that will help you to do it. But one last thing that I would like to show you guys here, if you are going to do this for a career, within FEG, Freedom Equity Group, in partnership with Fidelity and other careers that we work with, if you are to join us for this piece, this is what we offer. This is our compensation, how much you'll be able to pay, or rather to receive in payment. I'm showing you here a 30%, 35%, depending on when you come in. You don't have to have prior knowledge or experience, whatever. We get to train you ourselves. I know there are lots of other, companies out there that do offer, or relatively offer, soundingly similar approaches. But this is an approach that has not been seen elsewhere. Trust me, myself, I've been around. I've been around this industry for 8 years. I've worked with different companies out there that you can think of. But the 30%, the 35%, the 40% of what you're doing to come into your payments, even when you're not licensed yet. And if you're coming from another company, you're licensed and have been around here for a few days, have done some work here and there around this industry, we are well able to start you off at 55%. Now, when I talk of these percentages, you guys may get, for those of you that are new here, may get lost into the limbo as to what this means. But take a practical example of how much you're earning, or how much of a customer you just obtained or hoped. So we take that customer's premium, monthly premium, we annualize it, and then give you upfront the amount of money that customer is going to be able to pay for the next 12 months. And you get that one ahead of time. Now, what is it like to get 30% of an annualized payment or 40% of an annualized payment of your customer upfront when you're not even experienced, when you're not even licensed? Because some other folks get held back out of this industry because they are not licensed, because they are not trained, they haven't passed the exam. But we sponsor your education, and then we tag you to our licensed professionals, our experienced professionals to help you through, and then compensate you as you go, even though at that point you're not even able to do the actual work on your own, because you're tagged to a mentor that is doing this work with you along it, but you still get paid. I remember one of the companies that I used to be with before, I was licensed, we were licensed. I think they still do the same thing with licensed folks that are getting into the industry, but they're not even able to earn anywhere around 40%. And they're licensed when they should actually be getting somewhere around 55 or 70%, just because they've been around in the industry for quite some time. So the actual numbers as to how much, please reach out to the agent that invited you here. Reach out to me, myself as well. Ima is here. We can take you through the actual numbers of amount, how much you're able to get in interest of time. But if I can show you a quick piece that can actually help you get through this really fast, I would just show you our pay grid, which is the actual piece that I was telling you guys about. But if you look at this curve here, a regional manager, a regional vice president who is earning around 70%, this is how much they're able to earn. Average monthly premium of a client is paying an average monthly premium of $300 a month, just $300 a month. One customer, that's $3,600 annually if you annualize it. And then through our override formulas, because remember, the regional vice president has all these folks with them in their team. Even though they're not experienced, they're able to leverage, to override, to get those rewards of training and supporting those customers through their numbers. And they're able to get within their first year of service, they're able to get over 120,000. And this is not super hypothetical. No. This is an actual target number of $300 a month. So I realize I'm on top of on my hour. I don't have much time to go through the entire opportunity breakdown as to what it covers and what not. But trust me that this is a huge opportunity that will take you on the right side of the curve to what Robert Kiyosaki mentioned in the cash flow quadrant. And with this, I would like to get your feedback and questions and comments. I have a few folks that are my colleagues that we work together in this industry that are able to even chime in and answer most of your questions. But thank you so much for your attention. I appreciate you.
Great presentation, Mr. Diego. This was really very enlightening. So every time we come here, really, we learn every single day, not just the people who are new, who are just here presenting, but even anyone who comes in, at least you take out something, one or two. When you show us like those life pushers, so we have the income, we have the assets, but I might think that I'm making 200,000 a year, but I'm not even able to see what is coming in 2 months, whether I'm going to be hit with a critical illness or terminal, as you said. So I think the better thing is taking a step. We learn every single day. We learn from different presenters, but we keep pushing, saying that I'm good. My income is good. I can take care of my family. I can take care of my children. But what if that income is not able to come? What if you wake up tomorrow and you're not even able to go back to work? What happens then? Even if you're not owning a home and you're renting, are you even going to be able to pay that rent? I hope you'll be able to do that if you have at least some emergency funds saved somewhere. But unfortunately, because of those life triggers, we're not even able to save a lot of money to take us for at least 6 months if we have anything hitting our families. But if we have those life insurance products in there that comes with critical illness, terminal, chronicle, we won't have to worry much. So thank you so much again for a great presentation. We'll hear from other people. And if this is your first time, don't miss out next time, because every Thursday, same time, we're learning great ways of protecting our families and making our lives better like this from Mr. Hubbard. Thank you.
All right. Thank you, Emma. Appreciate you. Any quick questions? Open your mic up or raise your hand. Emma will be able to see you and call you out for comments or questions, please.
Thank you, Mr. Hubbard. Can you hear me?
Yes, sir.
Okay. Well, you did give us a good breakdown on the 4 quadrants of cash flow, according to Mr. Kiyosaki. In your journey, what has been your path towards change, moving from the left to the right, in terms of mindset and skills? What have you run into as you pursue this journey for the last 8 years?
Very good. Thank you, Roy. Let me take a few more questions all together to answer them.
Okay, my name is Leah.
Yes, Leah.
I heard you say that when you are already licensed and you want to join your company, I just want you to explain a little bit better. How do I come in? What do I expect? And the compensation part of it.
Awesome. Yeah. Very ideal question there. Thank you, Leah. I'll come back to that one. Maybe let me take one more. Any other person here want to make a question or a comment as to what we're talking about? All right. As you guys think about, okay, go ahead. Sure, Collins.
Hello, thank you so much, Mr. Hubbard. As always, a very awesome conversation and presentation. My question is on the employment side of things. I was wondering if you could speak a little bit about the rule about working for more than one company. Like if I have clients or I'm already licensed somewhere else, can I move and work for FEG, and what's the rules around that?
Awesome. Thank you. Yeah, let's start with these 3 for now. Again, as I mentioned, I have
I have a short question. It kind of goes with the others, Mr. Hubbard.
yes, Blessed. Go ahead.
I want to ask a question about what is specific or umwihariko for this company has than other insurance companies, because when you talk to different customers, they start asking, what do you do than other companies we met or we saw? Umwihariko w'iyi kampani yacu ni uwuhe twabwira abakiriya kugira ngo barusheho kumva? Thank you.
Awesome. Thank you, Jane. Kadutangirane bino bine for now. Noneho turaza gufata wenda ibindi. You guys can think through them as we go. To start with, kucho Roy asked about my journey. Now, I've been in the corporate America for the last 15 years. But over time, I think on year 8, I left Wells Fargo. I worked for Wells Fargo for about 8-9 years. Same industry, but then I was able to move from the left side of the quadrant, which was employee, to leveraging systems here in FEG and elsewhere. That's the freedom of being on the right side. Because once you're on the right side, you're able to move here and there. But if you're on the left side, on the W2 side or 1099 side, not having enough. By the way, don't be confused around the 1099. 1099 can be also on the right side, but the catch of the 1099 on the left side is not being able to leverage anything, just leveraging yourself, your time, your soul. So at that point, if you are not able to leverage anything, if you have to put in money, let's take an example of a truck driver. If you don't have a robot to drive your truck, then you're on the right side, even though you're on the left side, rather, even though you're working for yourself. Because at some point, if you get sick, or if your eye has a problem or whatever, you lose your hand at some point, then you're done. But if you are able to leverage a system or anything else to do your job, to do your work of a truck driving, then you're on the right side. So knowing where you are at any given point is determined by the leverage that you have. So to Roy's question, my journey has been pretty interesting. I'm at a point right now that I have no single W2 in my life. I started on the left side on a W2 when I came, on this side of the world, and I realized it's almost like 99 or 98 percent of the time you have to go through that pathway. Okay, well, a majority of the time when the people have to go through that pathway. But the issue becomes if you're stuck there, we don't have to be stuck on that side of the W2 piece. As a matter of fact, I think it's Abraham Lincoln or someone or some other president, George Washington, that mentioned that the beauty of being on this side of the world, that you start working for someone, then over time, you get enough money to buy the tools to work for yourself. And then over time, you are able now to employ others. With employing others, it doesn't necessarily have to be people, but employing the systems, employing the strategies, activating other things to work for you. At that point, you're no longer working for someone and you're no longer having to work for yourself, but something else is doing doing it for you. So that's where we're all supposed to go. I'm at a point where now I'm on the right side. I can leverage systems. I can leverage investments. I can leverage, there are lots of different, several levels. And as of now, tonight here, we're only talking about the finance side. Some other people are in technology, medical, whatever. But leverage options are the catch of being on the other side. So my journey has been pretty interesting around being on the left side. I was there for 8 years, as I mentioned. I was on the left side for 8 years until I started, pretty much 8 coming to 9, 8.5. And then I started making that shift to the left side. And when you start off, you find yourself, both legs, one leg on the left side and the other leg on the right side, leveraging systems. At some point, you start small within this industry, you're working part-time, and over time, your income grows. That's what exactly happened to me. I started working, I was still in Wells Fargo and got introduced to FEG back in 2017. I didn't take it seriously right there and then, because it took time to trust it and believe the system. We didn't have a lot of people back in the days that could talk to us about it. And now I'm all time in this side, and I still get more time to do something else, which is completely different than what I had or was able to do when I was still on the right side working for working on a W2 or for any given company. So that's much I can say there. I know people have great experiences when it comes to their personal life stories as to how they moved over. To maybe Ima, you guys can chime in at some point whenever you want to mention to jump in and share some answers as to what's been asked so far. But the second question, which is Leia. Leia's question was about how do you get on board here, getting licensed. So let me combine this with Jen's question. Umwihariko w'iyi company. So again, nababwiye je nabaye mu makampani naciye mu makampani atandukanye. Ariko the one company that ikora ibi bintu turimo nabonye iruta izindi kuri ku bintu nka bibiri cyane. What you're offering, the product itself, costing your product, pricing of the product. Kuko, yes, I'm in this, yes, for money, but above that, your turi industry, we are in a fiduciary responsibility to our customers. We assume a fiduciary. That means basically we have to do something in their interest. If I give my customer a product that they can't afford, or a seriously or crazily priced product, when on the market, there was the exact same product that will actually deliver even more on a relatively lower cost, then my fiduciary responsibility has been questioned right there. So, two factors: better products, right from pricing, right from the features of riders that we call riders in the industry, add-ons, and then the income piece. The income piece. Because remember, when I sell this product to someone, over time it becomes an asset. And to me, it's an income because I get those commissions. Now, combining it with Jen's piece, nuko aha niho honyine ubasha gukora ugatangira kwishyurwa. This is the place you're only able to start working, tag to an experienced person, and you're able to earn not just money, but higher rates. The rate that we pay here, let me show you this curve again. You guys are looking at my screen. Look at this. Joining Leia and Jane and everyone that would want to know, we start you on here on a 30%. And what it takes to join here, you just join. It's about random fee, which is it's standard across the board, across the industry, $125. You become a member. It's a commitment fee that you're serious about this. Once you have joined, we call you a training representative. You're now in the training, but whatever you're doing, of course, reviewed and approved by the experienced professional, you get paid 30%. Now, some companies out there, they don't even pay this much. There are some around 20 or 25, 30, when you have to be licensed. Now, as you move forward in your learning, you grow to 35% of whatever work you do, get paid upfront. District manager, you're not even licensed at this point, but you're already at 40. So if a company out there tells me I have to get paid 30% of what I do when I'm licensed, FEG here, Freedom Equity Group, tells you, no, we are good to pay you 55 or 45, depending on how you come in, what experience you come in with. So the payment piece is incredible and beats, most of these folks. But also the product that you're giving your clients is less costly. If you take a product that you're selling in FEG versus the same exact product that is being sold by another company, when we say the product is actually the, death benefits and whatever riders you have in there, FEG will in most cases beat those companies across the board as to the pricing of their products. And that's what I took time to look at. So umwihariko nuwo nuko wishyurwa better, ariko aba clients, aba customers urimo uhereza product bafite a better product, bafite ibintu bitabaremereye cyane. icyo bisaba nta kindi, vugana n'umuntu wagutumiye, vugana n'umuntu ubimenyereye akagufasha process. Usually iyo process ushobora uratangira ukaniga, barakurihira about what 75% of the cost you gitangira bwa mbere, kugira ngo wigishwe, bakaguhereza aba mentors bakwigisha all for free. All you have to do is just pay the $125 of your commitment to learning and growing. Ikibazo cya nyuma ni Collins about
let me add one more thing, Herbert, before you go
yes,
on the last one.
Go ahead.
Yeah, just on that, just to clarify, someone, yeah, that is good. So you come from 30 to like 45, but just to be clear, nobody who is not licensed is going to write a policy. Just to be clear, don't confuse it, saying that if you just join the FEG, you're going to start writing any policy. For you to write any policy, you have to be licensed. But your upline, who is licensed, is the one who is going to solicit the sales, educate the clients, and close all the sales. Just to point that out. Thank you.
Thank you, Emma. Yeah. So that's actually what we mean by being tagged to an experienced professional. So by tagging you is to review whatever you're doing. You're not going to write a policy. The policy will be written by but you bring those clients, you're able to prospect. You're free, allowed to go ahead and prospect your customers, bring them on board, and have an experienced professional that is tagged in your team. Not just one, you have many more that we call in this industry here uplines that are licensed to help you get them through, and then you get paid, even though you did have to write your policy yourself. Very good, very good. Yep, I hope that one has been exhausted. And the last question I have here was Collins about, the being able to work and the employment piece, which is, I mean, I'll term it, if I got him right, about being captive and independent and swinging around here and there, how much of a flex you have. Remember, you're on the right side of the quadrant. So you are independent. We are not captive agents, but in some sense, and for those of you that are sending pings in the chat box, I'm coming back to you in a minute here. Once you're on the right side, once you're independent, remember you're an independent contractor. Now you are free to make the calls on your time. But again, on the fiduciary responsibility, you don't want to, find yourself working for the same competitors on the same product. But if it's a completely different product, some companies would want you to restrict on their angle, but still you're independent. You're free to do when you want to do, or free to, because whatever you put in is what you get. If you don't put in much time, then as opposed to on the right or the left side where you have to be there to literally get paid. So the piece, if I got it right, the piece that you were asking about of the employment piece, you can move across the board, but then you don't want to conflict your profession itself by providing conflicting products themselves. Because some companies will say, no, we sell this product, we don't sell this. Okay, you're free to say, I can onboard here, I don't onboard on that one. But you're purely and independent, you take care of your own taxes, you take care of your own time. But the catch is, if you do more time, then you get more. And if you want to go work for another company, then you have still time to go work for that company, as long as it's not in direct confrontation or conflict with what you're doing already. Imar or Roy or whoever wants to add on that one before we get into the chat box.
Actually, on Corin's question, that is a good one. Like Herbert said, you are not, FEG is not captive at all, but we have what we call freedom share, whereby you actually become a shareholder, you get shares of the company. If you work with another IMO or another company, you can 100% get your commissions, but you never get a chance to share on the equity shares. You're not going to be able to get qualified on those. But other than that, you can write your policies wherever you want. But if you find a product that maybe is cheaper here, Why would you take your client on an expensive one? It is a choice to make as a profession as well.
All right, Jay. Jay mentioned in the chat box, what would I do if I did training in the past 2 years, but I'm not finished? Okay, would I be able to continue without repeating what I've learned? What would I be able to start earning, and how much could I earn before I work on a license? Ima, you want to take that one on, or I take it?
Yeah, you can, or you can. So he doesn't have a license. He will have to continue and get, depending on the state though. If you live in Texas, you don't even have to study. If you feel that you confident enough, you can go sit for your exam. If you are in a state whereby you have to finish that training, you must have to go back and finish the training. But you have to get a license to be able to solicit or even sell life insurance products. So with that, you can get help to be able to get your license, but you must be licensed to be able to actually sell.
Sure. Erica says, what's the percentage will I get since I'm already licensed? Yeah, I think we've already talked about that one, but just to reiterate that at least for sure it's above 45%. It could be 50%, 55%, depending on the nature nature of work, the amount of work you've already put in. And if you're already mentoring other people with you, we can take you all, with even higher credit numbers of 70 and above. And you're welcome even to come with your entire family. Right, Ima?
Right.
All right. The very last one or two more there, I think, okay, Eric mentioned what are the companies that work with, okay, what are the companies that work with Freedom Equity Group? I believe that's what it wants to be. Can we have a list? Or, I mean, I don't see the sense of listing them all together here, but we have predominantly in the term side, we have Corebridge and, the old AIG. Then we have Fidelity, companies like Fidelity Investments and National Life. And by the way, look at this. If you hang around this industry for long, you realize that most of these careers are in almost all IMOs. So if I'm in any given IMO, I may, find, those same companies, interestingly, even pricing different than where I used to be in any given IMO. So with FEG, we have Fidelity, we have AIG, we have NLG, we have many others that you can find of. But if you're looking around, the main company that it sounds that gets the front piece with FEG, we have Fidelity and Guarantee. Tina says, is it 55% on a person you recruited? That would depend on are you licensed? Are you not? Are you experienced? That's the percentage that we're showing on the pay grid. If you're not, then you start off on 30%. 55 is actually for someone that is licensed and has already started working and has actually written some policies in the industry, regardless of where you were, which company you were with. Yeah, that looks like it. I think so. Yeah, it got answered, I guess. I want to thank you again for your attention and contribution here. Let me pass it back to our host, Ima. Thank you so much.
Thank you, sir. You nailed it. There's not much to add. Thank you, everyone, again. Today, Thursday, every time, same link, same time. If you're invited by someone, reach back to them. This time, Mr. Herbert did a fantastic job, but at the same time, he cannot go to individual to explain everything based on you, because life insurance is based on a family's need, financial need, or an individual financial need. It will take you or as your family to get the best that fits your family. So come back next time, same link. See you next Thursday. Have a great night.